video we're going to look at investor ratios. First ratio is dividend yield. It's the dividend per share over the market price per share multiplied by 100. It provides an investor with the annual percentage return paid on a quoted share. Next we have earnings per share. And to calculate that, you have the earnings, which are the profit after tax, over the number of issued ordinary shares, again multiplied by 100. It's the amount of profit earned by each share after tax. And next one, dividend cover. It's the profit after interest and tax divided by ordinary share dividends paid, again times 100. It tells us the number of times that profit after interest and tax exceeds dividends. Price earnings ratio is the current market price over the earnings per share. It compares the current market price of a share with the earnings of that share. Right, here's a little example to explain it. So I've got an example. If the price earnings ratio is 10, then the current market price is 10 times higher than earnings per share. So the share is then considered to be 10 times more expensive than the last reported earnings of that share. A high price earnings ratio indicates that the market has been pushed up in anticipation of an expected improvement in earnings. Next one, interest cover. It's the profit before interest and tax divided by interest payable. And it tells you the number of times that the profit before interest and tax covers the interest payable. And the higher the amount is, the better. Right, now we're going to look at a little example now. So here we've got Nicola has £20,000 available for medium long-term investment in the ordinary shares of a company. She is wishing initially to maximise her income. Now, maximising her income is an important bit in the question. She has identified two companies in the same line of business and has gathered together the following information from their most recent financial statements. So, two companies. The first column is Perrin plc, second one is Porth plc. They give us various bits of information. The current market price per share, Perrin is £2.20 and Porth is plc. So it's more expensive to buy a Perrin share than a Porth share. You get more Porth shares than Perrin shares for the same amount of money. Share price in the last 52 weeks. So Perrin Limited, the highest price was £2.35 and the low price was £2.5. So there's a variation there of 30p. Porth plc, the high price was £1.10, the low price was £0.50. So therefore the variation there is 60p. So there's much more variation in the price of Porth plc compared to Perrin plc. That may suggest that Porth plc could be a riskier investment than Perrin plc. Dividend per share. In Perrin plc you get 8.5p per share and 5.3p per share in Porth plc. Dividend yields, you get 3.9% in Perrin plc and 14.2% in Porth plc. Dividend cover is quite similar in both of them. In Perrin plc it's 2.6 times and Porth plc it's 2.1 times. Earnings per share. So Perrin plc is 22p, whereas Porth plc is 11p. Price earnings ratio is 10 for Perrin plc and 6.8 for Porth plc. Return on capital employed is 7.2% for Perrin plc and 11.1% for Porth plc. So Porth plc is getting a higher return on the capital employed than Perrin plc. The final ratio we've got is capital gearing. For Perrin plc it's 35%, whereas Porth plc it is 80%. Now once that goes above 50%, that's considered to be a very high risk investment. So that's telling us here that Porth plc is a high risk investment because most of their capital is tied up in loans. Right, an extract from the financial statements. Statement financial position shows the following. Product, plant and equipment. Okay, we've got Perrin, the cost was £180 million, whereas Porth was £60 million. So that suggests that Perrin plc is a much larger company than Porth plc. It's got a much larger amount of non-current assets. Now, it could also suggest that Porth plc could be a growing company and has got more chance to grow than Perrin plc. So that's another potential there. Now, Nicola asked you to evaluate both companies from an investor's point of view and to advise her which would be the better investment. So in your evaluation, we're going to cover the following bits and pieces. We're going to quantify Nicola's possible investment and her expected income, compare ratios for the two companies, analyse the information to help make the investment decision, and conclusion is going to be a summary of the findings. Now here I'm giving you the answers here like in note form. So in a proper answer, you want to put them in more in sentences and paragraphs. So let's see what we've done. Right, you've got to remember she wants to have maximum income. So we know she's got £20,000 to invest, and parent PLC is one we're going to look at first. So to find out the dividend then, because that's the type of income, we've got the number of shares divided by the price. So it's £20,000 divided by £2.20, which means you get 9,090 shares. So the £20,000, that's the amount she's got to invest, and the price per share was £2.20. So that's where those two figures come from. Now, she'll have 9,090 shares. The potential dividend per year would be the number of shares divided by 90 times the dividend rate. And according to the little table here above, the dividend per share is 8.5p. So if you time together, you get potential dividend per year will be £772 and 65 pence. So I'll just let me highlight that for a moment. So that's what you'll get from parent PLC, a dividend, a potential dividend of £772 65p. That's based on the dividend per share remaining the same, not changing. Right, poor PLC then. See what we can do at poor PLC. So with the number of shares then here, she's got £20,000 to invest. And the price of the shares was £0.75 or 75p. So you do the calculation, she'll end with 26,666 shares. And now in the potential dividend per year, so look at the dividend per share. So dividend per share for Porth PLC is 5.3p. Times that by the number of shares, she'll now get a potential dividend of £1,413 and 30p. So purely, if the only interest is maximising income, she will get more income from Porth PLC than parent PLC because £1,430 30p is greater than £772 65p. I mean, that's based purely on the dividend income to maximise income. Now we need to look at some other bits and pieces now. Well, we've got to compare the ratios. We're going to work out what ratios are better for Perrin. So we go back to the list. So here we start with dividend per share. So Perrin is better than dividend per share, not dividend yields. It's better for dividend cover. It's better for earnings per share. It's better for price to earnings ratio. It's not as good on return on capital employed, but it is good for capital gearing. So let's just check we made a list of those ones there. So dividend per share, dividend cover, earnings per share, price earnings ratio, and lower gearing. I've also got here the share price is more stable. Let's go back to that now. I'll just show you where that comes from. So I said before, the share price of Perrin ranges between £2.35 and £2.5, a movement of 30p throughout the year. Porth PLC, it ranges from £1.10 the highest to £0.50 the lowest, which was a range of 60p. So the higher the range, the less stable the share price is. Now, when we say these ratios are a bit like dividend per share, we're going to put in numbers. What's the difference? So, for example, for Perrin, we say the dividend per share for Perrin is 8.5p, which is 3.2p better than Porth PLC. So each share provides a larger amount of dividends. We'll do similar things then with earnings per share, dividend cover, price earnings ratio, and gearing. Share price more stable. Again, put in some detailed information why that is. Right, what ratios are better for Porth? Now there's only two here, so let's go and have a look at them. So the dividend yields then. Perrin is 3.9% and Porth is 14.2%. So you're getting basically a better return on your money with Porth PLC. It's just over 3 times the amount compared to Perrin PLC. Return on capital employed, again, for Porth, it's better than Perrin. You get a return on the capital employed in the business of 11.1% compared to 7.2% for Perrin. Now we're going to make a little analysis of the information now. So Nicola wants to maximise her income. So if we've just worked out then, Porth PLC provides a higher dividend. So that was a £1,413.30p compared to the £772.65p. So again, you want to put it into a little paragraph. Porth's share price is less stable. I've mentioned it a few times. You want to say, why is it less stable? Explain in words how it's less stable. Now, because it's less stable, it can provide larger capital gains if she buys at a low price and sells if the shares increase in price, because the range of the price movement is higher in Porth than in Perrin. But it could have the opposite effect. It could also be a higher risk as the share price may fall. She may buy the share price when it's at a high price, then go down to a low price, so therefore there's a risk that her money invested will have a lower value. Porth has a better use of capital employed. So again, put it in a couple of sentences what it actually means. So compare the two rates of capital employed. And Porth has a higher gearing ratio, making it a more riskier company to invest in. So again, and also mention that it's above 50%, which is going to be a high risk investment. Now, I've got here, what is Nicola's attitude to risk? So you want to bring this into your answer. It doesn't tell us in the question what Nicola's attitude is to risk. So for example, do the companies operate in industries that Nicola would be happy to invest in? We don't know what type of companies they are, so we can't answer that question. So you need to bring it into the solution. Is there information available on the future activities of the company? Again, we don't have the information, so we need it as well. So back to the attitude to risk for Nicola. Is she a high-risk individual or a low-risk individual? We don't know, so we need to know that information to answer our question correctly. So bring it into the question. So we do not have her attitude to risk, so that's not being taken into account in the question or our solution to it. So a little conclusion at the end then. Nicola would have maximised her income by investing in Porth plc. Now remember, if you go back to the beginning of the question, it said Nicola's £20,000 available, and she wishes initially to maximise her income. So we've chosen straight away in our conclusion which company will meet those requirements. However, the share price of Porth plc is more volatile than that of Perrin plc, meaning that there is greater risk invested in Porth plc than in Perrin plc. If Nicola's investment is in the long term, then Perrin may be a safer investment. So if Nicola's investment is in the long term, then Perrin plc may be a safer investment. So that's a basic introduction to the type of things we're going to put into your answer to this question for investor ratios when you're deciding which company an investor should invest in. Thank you.